You've been told the secret to building wealth in 2026 is knowing what to buy. The right stock, the right sector, the right bet before everyone else sees it. That's what the headlines say. That's what the financial influencers are selling. And while millions of people are searching for the next hot thing, a small, quiet group of investors is building serious wealth. Not with a secret, not with a trend, with something so boring, almost nobody covers it. And that invisibility is exactly why it works.
Every year, there's a new story. 2021 was crypto and meme stocks. 2023 was AI. 2024 was AI again, louder. Now it's 2026, and the noise is the loudest it has ever been. AI stocks trading at historic premiums, crypto making headlines every week, new investment platforms promising outsized returns, new strategies that beat the market for a quarter or two. And most retail investors, people building from the ground up, are doing what they've always done. They're chasing the story. They buy what's already up. They sell what's already down. They shift strategy every 6 months based on what they read last Tuesday. They feel busy. They feel active. They feel like they're doing the work. But when they check their net worth 5 years later, nothing has moved. Meanwhile, the investors nobody writes about, the ones with no presence on financial social media, the ones who haven't made a single trade this quarter, they're quietly getting rich. And the trend they're riding isn't new. It's just invisible to everyone who's looking for something exciting.
Beat 1. The noise machine. Here's what the investment industry doesn't want you to understand. The most profitable product they sell is not a stock. It's your attention. Every headline that says, "Buy this now," that's a product. Every video about the hot sector of the year, that's a product. Every new ETF, every new platform, every new cryptocurrency, designed to capture your attention and redirect your dollars toward activity. And it works. Not because investors are foolish, because the noise is designed to feel like signal. In 2026, the same machine is running, louder. AI stocks dominate every conversation. Valuations are stretched. Everyone is searching for the next company that goes up 10 times. But here's what the actual data says. Over any 20-year period, roughly 95% of actively managed funds underperform a simple index fund. Not a few, 95%. Fund managers with Bloomberg terminals, research teams, and decades of experience. They can't consistently beat the index. And the implication is uncomfortable. If they can't, with every resource available, what does that say about the retail investor rotating between hot sectors on a phone app? It says what the data already confirms. Chasing trends is not a strategy. It's the opposite of one. The people quietly building wealth in 2026 have made a different choice. They looked at the noise machine clearly. They understood what it was designed to do, and they turned it off. Beat 2. The invisible strategy. Let's define what this actually looks like. Not in theory, in practice. Person A opens their investment app every week. They check the portfolio, they read articles, they adjust positions. They feel engaged. They feel like they're doing the work. Person B opened their investment account 2 years ago, set an automatic monthly contribution, chose a total market index fund, did not check it weekly, did not react to headlines, did not move money in or out based on what the market did last month. Person A has made 47 trades in the past 2 years. Person B has made 1. By every measure, returns, fees paid, tax events generated, stress accumulated, time spent, person B is winning. Not because they're smarter, not because they got lucky, because they understood something most investors never fully accept. The fewer decisions you make inside a good system, the better your outcomes. Inaction, when the system is right, is the strategy. Most people never treat it that way. They confuse activity with progress. They mistake busyness for competence. And the gap between those two investors compounds quietly, year after year, until it's no longer small.
There are 3 specific positions in 2026 where this approach has a real, measurable edge. Not exciting, not complicated, but backed by math that is very hard to argue with. Here's what they are. Beat 3. The 3 overlooked positions. The first is cash that earns a real return. For the first time in over a decade, money sitting in the right account is working. Treasury bills are yielding in the range of 4 to 5% annually. High-yield savings accounts are offering comparable numbers. And the vast majority of Americans still have the bulk of their liquid savings sitting in accounts earning less than 0.5%. They are leaving thousands of dollars on the table every single year, not from a bad investment call, from inertia. Moving your emergency fund and short-term savings to a high-yield account takes 20 minutes. Most people have not done it. The second overlooked position is dividend growth investing. While everyone is chasing capital appreciation, the stock that doubles, a quieter category has been compounding steadily for 30 years. Companies that raise their dividend every single year, not exciting companies, boring ones. Consumer staples, utilities, healthcare. Companies that made money in 2008, in 2020, in every downturn on record. They don't double in a year, but they don't collapse either. And the dividends, reinvested automatically, compound in complete silence. Nobody covers it. Nobody puts it in a thumbnail. But the math doesn't need a thumbnail. The third is the Roth IRA contribution gap. In 2026, the annual contribution limit is $7,000. The majority of eligible Americans are not maxing it out. Many haven't opened one at all. Every dollar contributed to a Roth IRA grows tax-free. Every withdrawal in retirement is tax-free. That tax advantage compounds over decades into a number that is genuinely significant. And most people are not taking it, not because they can't, because nobody told them it was the trend worth chasing. All 3 of these are available right now. No special access, no minimum income, no broker relationship required. The reason they're the trend nobody talks about is simple. They don't generate clicks, they don't generate trading fees, they don't move fast enough to make good content. But over a decade, the math becomes very hard to ignore. Here's what that math actually looks like. Beat 4. The compounding proof. Take a 35-year-old. Average income, nothing exceptional. They open a Roth IRA, contribute $500 a month automatically. They invest entirely in a low-cost S&P 500 index fund. They move their emergency fund to a high-yield savings account, earning 4%. They take the full employer 401k match, 3% of their salary. That's the whole strategy. At 45, 10 years later, their Roth IRA alone is worth approximately $103,000. Their 401k, compounded with the employer match, adds another $130,000 to $150,000. Their liquid savings have earned thousands in interest they previously weren't collecting. Total wealth built in 1 decade from one boring decision, approaching $280,000 to $320,000. From a single system set up in an afternoon and left alone. Now, compare that to the investor who spent those same 10 years rotating between trends. Crypto in 2021, AI stocks in 2023, whatever comes next in 2025. High trading fees, taxable events from constant turnover, emotional sell decisions at exactly the wrong moments. Same decade, completely different net worth. The uncomfortable truth is this. The investor who did less almost always ends up with more. Not because markets are random, because behavior is the variable, and behavior under pressure is expensive. Beat 5. Why nobody covers this. Here's the honest reason this remains invisible. It cannot be monetized by the people who profit from your attention. A financial media company cannot write daily articles about an investor who hasn't changed their portfolio in a year. An investment app cannot charge trading fees on someone who makes one transaction a month. A content creator cannot produce weekly videos about "I didn't touch anything and my account went up."
The boring strategy generates nothing for the industry built around investor activity. So the machine fills the space. New trends, new predictions, new frameworks, new emergencies. It isn't dishonest, it's just incentivized. Their incentive is your engagement. Your incentive is your net worth. Those two things point in completely different directions. The investors who see this clearly make a different choice. They stop consuming financial content as a substitute for financial action. They understand that more information beyond a certain point produces worse decisions, not better ones. More data creates more noise. More noise creates more second guessing. More second guessing creates the very behavior that destroys returns. The investors winning quietly in 2026 are not more informed than the average person. In many cases, they're deliberately less informed. They know enough to build the system, and they know enough to leave it alone.
Beat 6, the exact 4-step system. Here's what implementing this actually looks like in 2026. Not complex, not a course, not a subscription. Step 1. Move your liquid savings this week. Find a high-yield savings account or a treasury bill ladder. Move your emergency fund and any short-term savings there immediately. You are not investing it. You are not taking risk. You are simply collecting the return you're already entitled to. It takes 20 minutes. It's been available for 2 years. If you haven't done it, do it this week. Step 2. Open a Roth IRA if you don't have one. Set an automatic contribution. Pick a number that doesn't require thought. $200, $300, whatever starts without stress. Invest in a single total market or S&P 500 index fund. Turn on automatic reinvestment of dividends. Do not look at it weekly. Step 3. Take the full 401k match. If your employer offers a match and you are not taking all of it, you are declining free money every single paycheck. That is not a metaphor. It is a 50 to 100% instant return on that contribution. There is no investment on earth that guarantees that. Step 4. Set one annual review. Once a year, look at the accounts, increase contributions by 1%. Rebalance if you've drifted significantly. That's the entire maintenance requirement. 4 steps, 1 afternoon. Then leave it alone and let compounding do the work it's always done. The most dangerous idea in personal finance right now is that building wealth requires staying informed. It doesn't. It requires staying consistent. The trend nobody is talking about in 2026 is the same one that built quiet fortunes in 2016, in 2006, in every decade where the noise got loud and most people chased it. Automation. Patience. A system built once and left alone. That is the trend. And the reason it keeps working, year after year, decade after decade, is that almost nobody believes it's enough. The people who retire with real wealth are not the ones who found the right tip. They're the ones who stopped looking for one. They built a boring system. They automated it. They walked away from the noise. And they let time do what time has always done to money that's left alone. The boring investors always win. Remember that.